Let me start with the sentence that matters most. This is not, at least yet, a simple recession call. It is a leverage story. And if you understand leverage, you understand why a system can look fine on the surface, right up until the moment it stops looking fine everywhere at once. That is what I think many people still miss when they watch these market moves and assume it is all just another emotional panic, another war headline, another noisy week that will be forgotten once the indexes bounce. Maybe it will be forgotten, but maybe not, because the American economy right now is showing a very specific kind of fragility, not one giant collapse in one obvious place, but multiple cracks in systems that are all built on the same underlying assumption. Cheap, continuous, refinanceable leverage, and that assumption is now under pressure from several directions at once. The first place I want to begin is private credit, because I think most ordinary investors have no idea how large this space has become or how close it may already be to their own retirement savings. Private credit sounds technical. In plain English, it means private loans made to private companies, private real estate, and private infrastructure. Normally, when people think about lending, they think about banks. Banks take deposits, make loans, and operate under heavy regulation. There are capital rules, oversight, liquidity requirements, and at least some formal constraint on how much risk they can absorb. Private credit evolved as something different. A shadow banking layer. Money flowed from pension funds, insurance companies, and retail retirement products into large alternative asset managers. Those firms then lent that money to companies and projects at higher yields with less transparency and less oversight than traditional banking. That market has exploded. In roughly a decade, it went from almost nothing to around $3 trillion. Now, why did so much money go there? Because the returns looked attractive during the era of cheap money. For a long time, it felt like easy logic. Traditional fixed income was boring. Rates were low. Alternative credit promised better returns, more flexibility, and smoother stories about diversification. So pension systems put money there, insurance money went there, retirement-linked money went there, and now that rates are higher, investors are asking a much less romantic question. Can I get my money back? This is where the problem starts. These are not checking accounts. These are long-dated, illiquid loan structures. The assets are locked. The funds cannot instantly sell the underlying loans at full value whenever people get nervous. So when redemption pressure rises, you get something psychologically very dangerous. Investors discover that the product they imagined as stable income is actually a gated or semi-gated liquidity structure. That is why stories like Blackstone using its own capital and even employee money to help plug redemption gaps matter. That is why Blue Owl halting redemptions matters. That is why BlackRock limiting withdrawals matters. Those are not isolated anecdotes. They are signals. They tell you the private credit machine is discovering something uncomfortable. It worked beautifully as long as capital flowed in. Rates stayed manageable and refinance assumptions remained stable. But once fear rises, the mismatch between liquid promises and illiquid reality becomes visible. That is exactly the kind of mismatch that turns an ordinary financial stress into something larger. And that leads directly to leverage. A debt-based system looks stable only when the layers beneath it remain stable. This is why 2008 is still the right historical reference point. Not because today is identical to 2008, but because 2008 taught the most important lesson about leverage. It does not take the whole system to go bad. It takes one meaningful corner of the system to go bad in a way that forces everyone to pull back at the same time. People often forget this. The entire global system did not collapse in 2008 because every mortgage in America failed. It collapsed because a relatively small slice of a highly leveraged system failed in a way that destroyed confidence in every connected layer above it. That is the domino logic. This is what leverage does. If a homeowner puts $50,000 down on a $500,000 house, that looks fine while prices rise. But if the house falls 10%, the owner's equity is effectively gone. Now zoom out. The homeowner is leveraged. The bank is leveraged. The securitized structure holding the mortgage is leveraged. The insurance company that invested in the structure is leveraged. The government above all of this is leveraged beyond any normal historical standard. This is why small cracks matter so much in a debt-saturated system. It does not take everybody losing everything. It only takes enough pressure in the wrong places to trigger a chain reaction of deleveraging. And right now the system has several possible trigger points. The first is private credit. The second is jobs, especially white-collar jobs. And the third, maybe the most immediate, is oil. This is where the war in Iran enters not as a foreign policy side story, but as a macroeconomic accelerant. Historically, large oil spikes have preceded major recessions with alarming consistency. This is not mystical. Oil is not just another commodity, it is an input cost to almost everything. Food production, transportation, shipping, manufacturing, fertilizer, petrochemicals, aviation, logistics, energy itself. When oil rises fast, the cost of doing almost everything rises fast. Businesses feel margin pressure, consumers feel cost pressure, central banks feel inflation pressure, and governments feel political pressure. This is what makes the current moment so uncomfortable. Under normal recession conditions, the Federal Reserve wants room to cut rates, add liquidity, and cushion the downturn. But if oil is rising sharply because the Strait of Hormuz is threatened or disrupted, then rate cuts become much more dangerous. The Fed can try to support jobs, but in doing so it may reignite inflation through energy. That is the checkmate problem. The Fed has a dual mandate: low inflation and low unemployment. Normally it can defend one side by easing without destroying the other, but if oil volatility is severe enough, defending jobs may worsen prices, while defending prices may worsen unemployment. That is why the oil chart matters so much. And the problem is not only the market price of oil today, it is the structural fact that the Strategic Petroleum Reserve has already been drawn down heavily. In other words, the United States is less buffered than before. Now add labor market weakness. 92,000 jobs lost in February downward revisions. Weakness in information, finance, insurance, professional services, and here the AI issue begins to matter, but not in the simplistic science fiction way people talk about it. This is not about all jobs disappearing tomorrow. It is about enough white-collar jobs coming under pressure that credit quality, consumer spending, and tax revenue all begin weakening together. And that leads to another uncomfortable truth. The U.S. fiscal system is already extremely stretched even before a full downturn arrives. The federal government takes in around $5.2 trillion in annual revenue and spends about $7 trillion. That means almost $2 trillion in yearly deficit before any recession shock makes the numbers worse. Then look at where the money goes. A huge share goes to Social Security, Medicare, and Medicaid. A growing share goes to interest on the debt. A large share goes to defense. Add them up, and you realize something extraordinary. Core obligations plus interest already consume nearly everything the government collects. That means much of the rest of government is effectively financed by borrowing. So what happens if recession hits and revenue falls? The system becomes even more dependent on debt issuance or some other emergency form of balance sheet support. This is why the gold repricing theory becomes so interesting. I am not saying it will happen. I am saying it is one of the few escape theories that fits the structure of the problem. The United States officially holds roughly 8,000 tons of gold, but it values that gold at the absurd official accounting price of about $42 an ounce. A number frozen from the Nixon era. In the real market, gold trades at many thousands per ounce. So one theory is simple: revalue the gold, market to a much higher price, and instantly create a much larger state asset base on paper. Historically, the United States has done versions of this before, especially during moments of severe stress. Why would that matter now? Because it could serve as a balance sheet release valve, not enough to eliminate the national debt, obviously, but perhaps enough to stabilize confidence, recapitalize certain functions, or even support energy arrangements in a way that does not rely on straightforward money printing. That last part is crucial. If the Fed and Treasury are trapped because more printing risks more inflation, especially through energy, then a repriced gold balance sheet becomes politically and strategically attractive. There is also a wider geopolitical angle. The old petrodollar system worked because oil exporters were paid in dollars and parked wealth in treasuries under an American security umbrella. But if trust in treasuries weakens, if deficits keep rising, and if the war in Iran sends oil higher, then the United States may have reason to consider forms of settlement or collateral support that rely less purely on debt and more on a repriced hard asset. Again, not a certainty, but it is not crazy. That is why I think the real story of this moment is not simply, are we in a recession right now? The real story is whether the U.S. economy is moving toward deleveraging through several interconnected fault lines at the same time. Private credit, oil, white-collar job pressure, fiscal exhaustion, a central bank with less room than before, and a debt-saturated system where small cracks can trigger big chain reactions. That is the uncomfortable takeaway. You do not need the whole machine to fail. You only need enough pressure in the right connected places for everyone to start pulling risk out at once. And once that happens, the deleveraging process does not feel like one dramatic event. It feels like confidence leaving the system layer by layer until suddenly everyone realizes that what they thought was liquid, safe, and stable was actually conditional all along.